We would like to welcome everybody to Ashton College's second webinar event for this year. We're happy that you are all able to join us today for the Evaluating Investment Property Using Excel with Fred. Our event will last for about 45 minutes. And then during the event, if you have a question, you can put something into the chat, or you can save it until the end. If it has to do specifically with what Fred is discussing at that time, please feel free to raise your hand or jump right in. Otherwise, he will answer some questions at the very end. But thank you again, everybody, and thank you so much for joining us, Fred.
Hey guys, hope everyone is doing great. I'm going to share my screen. So the topic for this session is just a quick introduction for myself, and I'm one of the accounting faculty at Ashton, and normally I just present the accounting sessions, and this time I'm presenting the alumni event. My background is a chartered accountant from the automotive industry, and I also did my master's and specialized in real estate and sustainability. So the topic for this session is financial modeling in Excel, specifically regarding NPV analysis. We'll be going through two topics. One topic is on real estate. We have this example here of a rental property, and we want to utilize the NPV to figure out if this rental property is a good deal. And the second example is on CPP. We want to know, should a person in Canada collect their CPP at age 60 compared to 65 compared to 70, because this is an option that's offered by the Canadian government. So a quick overview on the NPV. The definition, by definition, NPV is to evaluate the present value of cash inflows and cash outflows. So the conclusion is that if the NPV is positive, most likely the project is adding value to the investor. If the NPV is negative, it means it's not adding value. So the first example here, we're gonna take a look at this property here is a property sold for 1.1 million in the Kitsilano area in downtown Vancouver. So the property is sold for 1.1 million. It is immediately rented for $3,300 per month. And we know the current mortgage rate based on the RBC rate is somewhere around 4.3%. So the question is, how do we know if this rental property is a good deal? So we're gonna go ahead and make some assumptions. We're gonna assume the purchase price is 1.1 million. We're gonna assume 2% closing fees, 20% down payment, the mortgage rate exactly equal to the RBC rate. And then we have the gross rent equaling to what the actual data is. I have grayed out the address just to not disclose the property. And then we're gonna assume 5% vacancy rate, 3% on the rental gross, 30% operating expense, usually just includes the management fees, strata fees, and then all the regular operations. 5% capital reserve. This one is referring to the money spent to maintain the building, like big projects, like if elevator breaks or if like a balcony or a roof needs repairs. So we budget 5% on that. And then we hope to earn 5% rate of return. So basically we hope to get a 5% on our investment. And then at the end of the holding period, we hope to hold this property for hopefully 10 years, and then we're gonna sell this, which at that time will have a 3% realtor fee and a 3% annual growth rate. The 3% annual growth rate is a estimate based on the data from the Vancouver housing. The past 10 years, the property in Vancouver has grown annually roughly 4.8%. So we just want to be a little more conservative, and we're gonna just use 3%. So now we have all the assumptions, and now we're gonna do the NPV analysis. Remember, from the objective, NPV is the value of cash inflow and cash outflow. We're just gonna go ahead and set up our NPV chart. So we make the assumption that we're gonna hold this for 10 years. The first line is the gross rent. So this is the annual rent that we're getting. So we take the monthly rent times 12. And then we reduce the money that we're getting from the rent by the 5% vacancy rate. And we get our gross rental income. And then we reduce the operating expense and the capital reserve, basically utilizing the assumptions. So the 30% operating expense and then the 5% on the capital reserves. At the end of year 10, we hope to sell the property. To get this number, we will take the initial price and use the annual 3% growth rate. So take the initial amount times the 3% growth rate over 10 years, minus the 3% realtor fee. Once we set this up, we will have a property level cash flow before interest and tax. And then we'll calculate the debt service. The debt service is calculated through a amortization table. So what we are trying to do here is utilizing our assumptions. So we are assuming the purchase price with 20% down payment, meaning 80% of it is borrowed from the bank. So we set up the amortization table with 80% amortized over 30 years, which is the standard. And then we can get our monthly payment amount, and you can see here up to year 30, it will be amortized to 0. So we'll go ahead and add the debt service. And this is applying for year 1 to year 10. For year 0, at the very beginning, we will include the acquisition cost, which is the purchase price plus the closing fees. And we'll reduce it by the debt proceeds that we get from the bank for the mortgage. And then at year 10, we'll have to pay off the mortgage based on the amortization schedule and see what's remaining. So once we have the assumptions entered into the NPV analysis, which again, you can see here, if we need to go into detail, we'll discuss every single variable. But if we don't need to discuss every single variable, it's just cash inflow minus cash outflow. And we're just utilizing the assumptions to get the actual numbers. Once we get all the numbers, we can see here the annual cash flow from year 0 to year 10. And at this point, we can just use the function NPV. So you can see here, we're utilizing the Excel function NPV. And this formula is asking us a few variables. The discount rate. So that is the required return that the investor is hoping to achieve. And the combined cash flow from year 1 to 10 plus the initial investment. When we get all the information set up, and we see the number here is $7,000. So what does this number mean? It means that if we take on this project, assuming this price with all the debt, operations, and sale assumptions, discounted at 5% return, this project at today is worth $7,000 plus. So if we only look at the quantitative analysis, this seems like a almost barely better than break even. So it's not really that good of a deal. In addition to that, you can look at the cash flow forecast. Every single year, the cash flow is negative, and this is caused by the rent collected minus the operating expense is lower than the debt service, which is the mortgage plus principal payments from our amortization schedule. So really the value added from the property is not through cash flow, is through the appreciation of the property. And at the current rate, is all over the news in the Toronto and Vancouver, the property is not selling. So just be aware that when we make the assumptions to make sure we put in the reasonable numbers. So that's the first part of setting up the NPV. The second part is to use a function called goal-seek. So this function, you can get this through the link on the spreadsheet, and you can just get it through the Excel add-ons. So on the add-ons, you can just search for the goal-seek. And you can see the spreadsheet add-on. It doesn't really have good reviews. It only have 2.7 stars, and I don't know why the people are not liking this, but I tried the function. It works great. So you can see how we set up the formula. The objective is if we want to make 10% annual return, what do we need the gross rent to be? So let's go ahead and use the function here. You can just see here, I want to set the required return to 10%. So set this cell to, it doesn't allow the percentage, so I'm going to put 0.1, which is 10%. By changing cell on the gross rent, this changing cell, it can be any of the variables. But in this demonstration, we're only going to use the gross rent. So we're going to go ahead and do this. And then we're going to solve. You can see the add-on is trying to figure out how it can get to the correct number. So you can see here with the goal-seek function, if we want to have a 10% annual return, the result is $5,800. So the question is, what can we do with this kind of analysis? Well, how realistic is it for this property in this area to command this kind of rent? So basically, the purpose of the goal-seek is to do a few feasibility analysis and just determine what is the likelihood of our assumptions and whether they make sense. You can go ahead and try this and see if you can get the same results, or you can just go ahead and try the amount with different numbers. So that's the demonstration for goal-seek. The next topic is qualitative factors. So we have to remember, even though we're doing a NPV analysis, which is mostly quantitative, where we're trying to calculate if the project is profitable or not, we also need to consider qualitative factors, and there could be many. The first one, the location, the most important one for real estate. How safe is the neighborhood? How convenient is the transportation? Is there any good schools, job opportunities, all the convenient factors, hospital, groceries. For neighborhood safety, there is 2 reports from the Vancouver Police and the Toronto Police. You can go ahead and check the link, and you can just see how much crime is under each of the areas and what kind of problem they have, and do our own research to see if this is a safe neighborhood or if we want to live here. Usually the safe neighborhood will command a higher premium on the home price. The first one, the most important one, is the location, and then the other one is the economic. Because you can clearly see here, I have made a lot of assumptions on the rates. The mortgage rate at this moment is the 4.3%, but it could easily change over time, and that could impact the analysis. The next one is the terminal value. So we made the assumption that we're hoping to hold this period for 10 years. And so how does that, what does that impact us? So in real estate, there's a term referring to the highest and best use. So basically, you're holding this property for 2 reasons. One, you hope the property will generate sufficient cash flow, and the other one is you hope the location will be able to appreciate. For properties, maybe if it's located in central areas, could be a large building or a large area where it could be beneficial for redevelopment. So like an old 2-bedroom low-rise buildings in a prime location, it is very possible the developers over the 10 years could just one of the years they'll come here and ask to potentially buy out the entire area. In that case, you will be able to cash out at a significantly higher return. So make sure we understand what is the best use, and also some areas are zoned for residential, others are zoned for commercial, so it cannot be redeveloped into a different area without approval. Yeah, you can take off the raise hand if I'm not sure how you do that. The other one, NIMBY is a term referring to not in my backyard. So some, like, think about the prime location in Kisangani, like how likely is it if you are in this area and a developer comes in and hope to build a huge tower, and you're just gonna say no. So that's another factor that can impact the terminal value. The third point is the design. So there's a huge push mostly from the Liberal Party for a sustainable future. You can say this is a big sell for going green, but also So the main thing that we should just be aware is the LEED certification. This is the recognized globally leadership in energy and environment design. It has a few different certifications. You can see the platinum, gold. It just ranks the design and the operations by a few benchmark metrics and see how high the points it can get, and I'll give you a certification. The main idea of the sustainability buildings are just saving energy, like low carbon dioxide, more energy efficient, less pollution. And then you can even see here under the city of Vancouver, there is many of the green facilities certified by LEED gold standard. So all these ones generally, the benefit is you can see here the high efficiency, better heating and cooling, and then all this other bonus. And the reason this is important in real estate is, generally speaking, the buildings that are more sustainably designed usually command a premium over the normal ones. And the reason is they're more comfortable to live in. So that's another factor to consider. So the conclusion of the first example is just be aware that we're building a real estate analysis using assumptions that we make, and we calculate the net present value and see if it makes sense financially. And then we consider all the qualitative factors, and we combine our analysis between both the NPV and the qualitative and make our decision. The next example is CPP. So this is only applies to people working in Canada, and CPP stands for the Canadian Pension Plan. So the reason this is an issue is the government, it offers people to retire early and start collecting CPP at age 60 at a reduced rate, or we can defer this to age 70 and get a premium. The exact amount is on this government Canada website. If we retire at age 60, we'll get a 36% reduction. If we retire at age 70, we'll get a 42% premium. So the question is, how much of a difference does it make if we start collecting money early, but at a bigger discount? So again, we're gonna go ahead and make some assumptions. The monthly payment that we're getting based on the 2025 number here, you can see is 1433. So that's the monthly payment. The growth rate based on the government of Canada, 2.6%. So this is how much they will increase the CPP over time based on the consumer price index. The discount rate, we're gonna go ahead and use the Bank of Canada bond rate at 3.5%. And then the age impact, we're just gonna use the number from the government of Canada website. So if we start collecting at age 60, we'll get 64% with the 36% discount. If we're collecting at 70, we'll get a 42% premium. The life expectancy, and this one is important because the CPP by design, so if we start collecting at age 60, where the CPP expects to pay us 22 years. The life expectancy on average is roughly, we're just gonna use the assumption at 82. So once we have all the assumptions, we're gonna do the exact same analysis. We're gonna first do one with collecting CPP up to age 82, and then we're gonna do another one collecting up to age 90. So the first one, we're gonna assume that we will just live to the average at age 82. And we collect under the three situations. The first one at age 60. So by age 60, we already have our CPP income, which is the monthly payment times 12, monthly times 12. So that's the annual one. And we're getting a 64% discount. So we're gonna go ahead and discount this by the amount. And that is our annual cash flow. We're gonna discount this back using the interest risk-free bond rate at 3.51%. And we'll get an NPV. We're gonna do the exact same for age 65 and 70, but there's a difference here. At age 65, it means the first 5 years we're not getting any money because we're still contributing, or we're just not collecting at age 60. Between age 60 and 64, we're not collecting any money. So we're gonna assume this is 0. And we do the same assumption for the age 71. So the first 10 years, we're not collecting. But from age 11 and onwards, we can see here we're using the base rate, and we're gonna increase this by the 42%. Once we do all the calculations, we can compare the NPV of the three methods. So you can see here, under normal situations, it does look like 65, starting the CPP at 65 gives the highest NPV, but it's not much. It clearly looks like not a good deal if we start collecting at age 70. But between age 60 and 65, you can see the NPV difference, 8,000. So this the difference between the two methods, it just means the person, if they collect the money 5 years afterwards, it is worth 8,000 more to them today. We're gonna do the exact same calculation, but this time we're going to extend our life expectancy to age 90. So basically, we want to beat the average. If we do everything with the same variables, the first 5 years without collecting, and then starting at age 70 with 10 years no collection, and we compare the NPV, now we can see that it still looks like the person starting at age 65 is getting the highest, but the person start collecting at age 60 now is getting lower than the person starting at 70. So this, one of the impact for this is it depends on the growth rate and also the discount rate. If we make the assumption of the current growth rate based on the consumer price index and the current bond rate over the 20 years between age 70 and 90 and collecting 42% more appears to be a better deal than collecting 36% less, because we can think about the difference between the two. This is 64% of the benchmark, and this is 142% of the benchmark. So that's almost 80% higher, waiting for 10 years. And also we extend the life expectancy to 90. So now we have the calculations, but we want to know, so what should we do? What is the best offer to us, given that we have a choice to choose between 60, 65, and 70. Well, we cannot just look at the numbers. We have to, again, consider qualitative factors. The first one, on the personal level, what is our life expectancy? Somebody living a really healthy lifestyle, thinking they will live way past the average, is more likely to benefit from delaying collecting CPP. Or somebody else who is really thinking that they can only meet the average, it may be better for them to start early on the collecting CPP. Personal finance, some people maybe they need money early. Like not everybody has time to wait until age 70 to start collecting. Some people they just want to retire and enjoy life a little bit. They don't want to wait 10 years. So they can do a lot of things with the 10 years that they have, and they don't want to wait. The other income sources from a tax perspective, the old age security, there's a callback if the person makes income higher than a threshold. So what this means is if the person is delaying their CPP to age 70, and at this point they still have other earnings, and their annual earning exceeds the max, the old age security will charge them back 15% of the amount. So that's quite a lot. So if the person has a lot of income sources and they expect to continue to have high income way through their retirement, going to collect the CPP at a later date may be not a good idea from the tax perspective. Economic conditions. So again, we make the assumption that from the Bank of Canada that the bond rate is 3.5%. This changes every quarter. Every time the central banks make a decision, they either increase or decrease the rate, and that could change the analysis. The opportunity cost. So let's take a step back and think about this. In the first situation, even though the NPV looks not a good idea, it looks lower, but the person is getting money for 10 years early. Can this person make a return from the money that they're getting? The CPP is only giving them a 2.6% return. Can the person make a higher return and make up the difference? Just putting the money in the GIC right now is higher than 2.6%. So even though it looks like a big loss for the person collecting money early, where it looks like they're not getting the money, it can easily be argued that if the person is a sound person with their own finance, they can easily get the money early, redirect the fund to the just putting it through the GIC, and it will be a higher return than the CPP. So we'll have to consider the opportunity cost on this. At the same time, if the consumer price index is a huge amount, like maybe the country is not doing well and had a huge inflation, this number could be much higher. If that's the case, maybe it's not worth it for the person to do their own investing. So to summarize, we need to answer the question, which of the three situations is better? So we're gonna go ahead and change the number. We're gonna change this growth rate. So let's assume the country is not doing well and the inflation rate is really high. We're gonna change this to 10%. Now you can see here the person withdrawing early is getting the highest return from the withdrawing early. rather than just waiting. So what does this mean? This means the NPV analysis is sensitive to all the variables. If the inflation is high, it may be beneficial for the person to get the money early because it will compound earlier at 10%. Over the 5 years, the compound impact of the 5 years at 10% is going to outweigh delaying it. So that's one example. And starting at age 65, that would be the average. So what is under what situation would starting at age 70 be a good idea? We're gonna lower the discount rate. So let's say we have a really slow economic growth, and the Bank of Canada, and they have done this at between the COVID years, they have the bank interest rate at almost 0%. So we're gonna put this at 1%. It means that the money is really cheap and there's no return if we just put it through the bank. If this is the case, now we can see here that starting at age 70, this one gives the highest NPV. And the reason for that is when the discount rate is really low, we cannot get the return elsewhere. So it will be better to get the return from the CPP. So we need to, what is the conclusion on this is we need to consider our personal needs. What is our life expectancy? What do we need money for early funding? Are we gonna take advantage of the tax benefits and then make our own judgment? There's no right answer on this one. It depends on our situation. We can easily make one option better than the other one by changing the variables and do our own test for assumptions. The other factor we need to consider is, you can see here, there's a lot of political change. We just had a federal election, and the thing that's worth highlighting is Alberta is not happy for many reasons. One is the policy is not really helping them, and the other thing is the people in Alberta feel like they're working and contributing to CPP, but they're not getting. And the reason is the people who are from Alberta are mostly working, so they're contributing. But when they retire, they kind of just may choose to leave the province and maybe go to BC for the better weather or go back to Ontario. So how does this matter to us is that you can just see the news, the Alberta, they want out of CPP. So we can do the best calculation that we can with the numbers and feel like, oh, we did every math correctly, and we maxed out the highest probability of us benefiting based on the net present value. But something changes in the political environment, and for example, if Alberta leaves CPP, if any province leaves, the whole calculation will have to be redone. So even though we're contributing over our entire employment years from the time we start working up to when we retire, but we don't really know what can change over the 10, 20, 30 years, and any of this can change. So we need to consider the CPP as what it is. It is an insurance policy, and the CPP is the house. So normally you have to beat the house to win, and it's very difficult because when the house realize that the life expectancy is getting higher, they will simply adjust the payment. They will adjust the inflation rate because the house, as the CPP, they will not go bankrupt. So it's very hard to beat the system. And we have to just keep this in mind. We're using this as an example to demonstrate how to do a NPV analysis. But I also hope that we can consider and the situation and see if we can make some decisions with the analysis. And we have the same conclusion. That is, when we do a calculation for NPV, whether it's the CPP or if we do the real estate one, we are going to do the best we can to get the variables, but just by doing the numbers is not enough. We have to consider qualitative factors and combine them to make our decision. That's it for this presentation for the two examples.
Thank you very much, Fred. If you could go to, do you have any questions that you can see there? If not, I have some here.
Yeah, I'm gonna go ahead and start from the one that was asked earlier.
Go ahead.
The one asked earlier, what is the Excel skills for real estate investment? So it needs a lot of different things. Like you have to do the Excel. You might also have to get a CFA, Chartered Financial Analyst. So what that does is you will do a lot of NPV analysis and you will do a lot of risk analysis. If you are really interested in real estate, you would try to see on the job search sites and see what kind of requirements that they have. But I suspect you need minimum the bachelor's plus maybe a CFA, and maybe you may have to have some design background, like architect. Those ones are also very important.
Thank you. And one of the questions here is, what's one common mistake new investors make when analyzing real estate opportunities in Excel?
So we used the real estate example here to demonstrate, but we're not here to offer investment advice. What we want you to consider is the assumptions that we make here, and we want to be as reasonable as we can. We don't want to inflate the numbers to make it look like we're making money on paper. It doesn't really help. Like we can use this goal seek function and try to make 10% IRR. And we're gonna adjust the rent to the 5,800, but nobody's gonna pay that. Like even at the prime location, it just doesn't. It's not feasible. And also the other thing we consider is the best use and the highest and best use. Whatever that we're making the assumption, it need to be feasible. It need to be legally feasible, physically feasible, and financially feasible. Like we cannot say that we're going to make a huge amount of money from a redevelopment when the zoning doesn't allow that. So you cannot say that we're gonna develop a tower and make 20% return when the city doesn't allow buildings above a height, and then you cannot. It's not feasible. So the answer is to be realistic on making the assumptions.
That's great. I mean, we definitely don't want to be playing around with the numbers and then come out with some, unexplained outcomes or even something that's not feasible. So thank you for that. Our other question would be, are there any alumni or networking groups where we can continue developing these skills collaboratively?
I think we have some very interesting webinars similar to this one coming up. Is probably in the making. I think it will be up to the school to make the decision on what can add the most value to our student network, and hopefully maybe there could be like some surveys or how the process will work, and so I think it is going to have something interesting. So uh, keep posted on the events, and hopefully there's some new ones coming up.
All right. I would also recommend for anybody to join the Facebook Ashton College alumni group. You are welcome, of course, to talk about things like this there and try and reach out to some other alumni people, as well as you are welcome to email me at alumni@ashtoncollege.ca for any questions that you have regarding anything like this, or like any events that you're interested in, and we can discuss it further. The other thing I wanted to bring up with everybody in the alumni is that we do have some courses coming up in the accounting department where Fred is part of our faculty. We have the Canadian GST and HST basics coming up with the start date of May the 5th, as well as Canadian income tax on June the 3rd and payroll administration on June the 4th. So if you're interested in any of those, please go to our website at ashtoncollege.ca for more information. And Fred, did you have anything left that you wanted to leave our attendees with today? Any last minute thoughts on this? It's been a great seminar and been very interesting.
Yeah, and I hope everyone is having a great day. Thanks everyone for attending. Let us know your feedback, what you like or what you hope to see in our future events, and we'll try the best we can to make it work.
Absolutely. Thank you very much, Fred. And thank you, everybody who joined us this evening. I know we're ending a little bit early, but as I said, feel free to email me with any further information or any feedback that you'd like to give us so that we can make these events happen. They are happening about every 3 to 4 months, but feedback is always welcome. So thank you again, and thanks, Fred.